Hello, good morning. Good morning, all of you. Look at this problem. Look at this small problem. Mr. X has to pay rupees 10,000 after 5 years from today. A 6 year 8% rupees 100 bond is issued at par. Determine how much amount Mr. X has to invest in the bond so as to meet his obligation after 5 years. What amount he will accumulate if the market interest rates continues to be 8%, falls to 6%, or rises to 10%. Okay, very good problem. We'll learn a lot of concept in this problem. So practical relevance is there. It's a very good problem. Okay, just look at this. So Mr. X has to pay rupees 10,000 after 5 years from today. That means he has an obligation to pay rupees 10,000 after 5 years. For that, he wants to invest now itself. Okay, this is a long-term planning. This is a long-term or medium-term investment planning. So I have a commitment to repay 10,000 after 5 years, or I want to build a house after 5 years. So after 5 years, this much will be the cost of the bond. For that, how much I should invest now? For that, how much I should invest now? In order to obtain 10,000 rupees after 5 years, how much amount to be invested today? In order to obtain 10,000 rupees after 5 years, how much amount to be invested today? That is the question mark. Okay, what is the question mark? I'll write for your clarity. I'll write the question. So what is the question? So question is, in order to obtain, in order to receive rupees 10,000 after 5 years, in order to receive rupees 10,000 after 5 years, how much amount to be invested? How much amount to be invested today? How much amount to be invested today? This is the question. In order to rupees 10,000 after, in order to receive rupees 10,000 after 5 years, how much amount to be invested today? That is the concept. Okay, right. So very simple basic calculations, present value, future value formula. So this 10,000 to be received after today, 10,000 rupees received after 5 years. This is the future value. This is the future value. Amount to be invested today. This is the present value. Present value. Present value. Okay, they have given the future value. We need to calculate the present value. We know the present value, future value formula. Future value is equal to. So future value is equal to. So we know the future value, present value formula. Future value is equal to present value into 1 plus r whole to the power of n. 1 plus r whole to the power of n. So here we got the future value of 10,000, required future value of 10,000. Present value we don't know, that we have to compute. Okay, present value we don't know, that we have to compute. Into 1 plus rate of return. How much we can earn if I invest certain amount today, on that how much interest I earn during this 5 years. If I want 5 years after 5 years, if I want rupees 10,000 after 5 years, I need not invest entire 10,000. It's of no use, because during this 5 years I can get interest amount. Therefore, it is sufficient if I invest less than 10,000. So in order to obtain 10,000 after 5 years, we need not invest 10,000 today. That's a foolishness. We have to invest less amount. On that less amount, interest will be accumulated. Our investment amount plus interest together is equal to 10,000. Okay, our investment amount, investment plus interest on that together is equal to 10,000. Therefore, this investment will be less than 10,000. Obviously, on this 10,000, on this investment, I learn the interest. On this investment, I learn the interest. So investment will be less than 10,000. Okay, investment will be less than 10,000. So how much is the rate of interest? How much rate of interest I can earn? This is the question mark. Now we have to find out rate of interest prevailing today. So our question is rate of interest prevailing today. Rate of interest prevailing on the date of investment. Rate of interest prevailing on the date of investment. On the date of investment, what is the rate of interest? On the date of investment, what is the rate of interest? Okay, look at this. That we have to ascertain by looking at the question. On the date of investment, how much is the rate of return? On the date of investment, how much is the rate of return? So how to identify? Look at this. They have given the question mark. A 6-year 8% rupees 100 bond is issued at par. Bond is issued at par. This is the key sentence from which we can interpret what is the present rate of interest prevailing in the market. Bond is issued at par. So bond is issued at par means bond is issued at a face value. So when the bond will be issued at face value, when the supply and demand for the bond matches equilibrium, when the supply and demand for the bond matches, when the supply and demand matches, then the bond will trade at premium par value. When the supply and demand matches, okay ma, so when the supply and demand matches, the bond will trade at face value. Okay, the bond will trade at face value. Okay, this is the question mark. This is the concept. Okay, when the supply and demand for the bond, when the supply of the bond, when the supply of the bond and demand for the bond matches, the bond will trade at face value. The bond will trade at face value. The bond will trade at face value. This is the first point. The bond will trade at face value. This is the first point. And the second point is that when this happens, when the supply and demand matches, when the supply and demand matches, okay, so when the investors are satisfied, when the investors are satisfied, neither excited nor disappointed, neither excited nor disappointed, when the investors are just satisfied, when the investors are just satisfied, neither excited nor disappointed, okay, neither they are too happy nor they are too worried, okay, they are satisfied. When the investors are just satisfied, supply and demand matches, supply and demand matches, supply and demand matches. Okay, so when this will happen, when the investors are satisfied, when the investors are satisfied, when the coupon rate, when the coupon rate offered by the company, when the coupon rate offered by the company is equal to the yield expected by investors, yield expected by investors, yield expected or required by investors, yield required by investors. Okay, the investors are just satisfied. The investors are just satisfied. The investors are just satisfied. Okay, this is what the point. Okay, that means what? So look at this concept. Look at this concept. Bond trades at face value. Bond trades at face value. Okay, bond trades at face value. When this happens, supply and demand matches. Supply and demand matches. When the supply and demand will match, investors are satisfied. Investors are satisfied. That means coupon is equal to yield. Coupon is equal to yield. Next, bond trades at premium. When the bond trades at premium, demand exceeds the supply. Demand is more than supply. Demand is more than supply. When this happens, investors are excited, not just satisfied. They are excited. They are very much happy. When this happens, coupon offered by the company is more than yield. When the coupon offered by the company is more than yield, investors are excited, and the demand is more, supply is less. Obviously, the bond will trade at face value. Discount. So discount what? Discount when the supply is more than demand. When the supply is more than demand. When this happens, supply is more than demand. When this happens, when the investors disappointed. When the investors disappointed, this happens. When the investors disappointed, this happens. When the investors will disappoint, when the coupon paid by the company is less than the yield required by them. When the coupon paid by the company is less than the yield required by them. This is our fundamental concept. This is our fundamental concept. In our example, they have given that bond is trading at face value. Therefore, coupon is equal to a yield. So coupon they have given as 8% in the question. Coupon they have given as 8% in the question. Coupon they have given as 8% in the question. Since the coupon rate is 8%, yield is also 8% based on this logic. Since the coupon is 8%, yield is also 8% based on this logic. Because when the bond will trade at face value, only when the coupon is equal to face value, only when the coupon is equal to yield, then only the bond will trade at face value. Only when the coupon is equal to yield, the bond will trade at face value. So they have given that bond is equal to face value. That means the yield expected by the investors. So this is the hint. Bond is issued at par. That is the hint, which indicates that yield is exactly equal to the coupon. Coupon is exactly equal to the yield. Coupon is exactly equal to the yield. How much is the coupon? 8%. 8% is the coupon. Therefore, required yield is also 8%. That is how we have to write it here. Okay. Sir, on what basis I got 0.08, sir? On what basis I got 0.08, sir? Coupon is 8%. So since the bond is trading at face value, coupon is treated as an yield. Coupon is taken as equal to yield. So coupon is taken as equal to yield. That is the answer, ma. So since the bond is issued at par, since the bond is trading at par, coupon rate is taken as the yield. Coupon rate is taken as the yield. Okay, right. That is also note points I'll give. Note points I'll give in the given case. In the given case, since the bond is issued at par, we assumed that yield is equal to coupon. Yield is equal to, or coupon is equal to, both are same. We imply that coupon is same as yield. Coupon is equal to yield. Coupon is equal to yield. Therefore, therefore we have taken yield as therefore we have taken yield as 8%. Therefore we have taken yield as 8%. That is the point. In the given case, since the bond is issued at par, we imply that coupon is equal to yield. Therefore we have taken yield as a 8%. That is the point. We have taken yield as a 8%. Right now we have taken yield as a 8%. We have taken yield as a 8%. Right now, that is the point. Next, so a 6-year 8% rupees 100 bond is issued at par. Next, determine how much amount Mr. X has to invest in the bond so as to meet his obligations after 5 years. So that is the present value. Present value you have to find out. So how many years? 5 years from today. That means how many years he was investing? How many years he was investing? He was investing for 5 years. He was investing for 5 years. Therefore, present value is equal to, so 10,000 is equal to present value. How much is investment into 1.08 to the power of 5. So present value into 1.08 to the power of 5. 1.08 to the power of 5. Okay. 1.08 to the power of 5. 1.08 to the power of 5. 1.47. 1.47 is equal to 10,000. Therefore, present value is equal to 10,000. So we'll keep the present value like that only. 10,000 divided by 1.47 is equal to present value. 10,000 divided by 1.47 is equal to present value. 10,000 divided by 1.47 is equal to present value. That will be 10,000. 10,000 divided by 1.47 is equal to present value. 6,806. 6,806. I'll make it the round figure. I'll make it as a round figure. 6,806. 6,806. That is the present value of the investment. This is our one of the main answer. You can take a screenshot of this or you can take a photo of this. This is the main answer. Amount to be invested today. This is the answer. 6,806 is the amount to be invested today. Anyway, failed solution will be having in the middle, which I have given. This is just for your classroom discussion, rough calculations. Presentation purpose, you can look at the main material which I have given. So this is a rough calculation to understand the concept. Okay. So amount to be invested today is equal to 6,806. This is the question. So determine how much amount Mr. X has to invest in the bond so as to meet his obligation after 5 years. This is 6,806. But the important point is what is the assumption? What is the assumption behind these calculations? What this calculation assumes, not just substituting the formula. What this calculation assumes? This calculation assumes that 8% is the compound interest. 8% is the compound interest. Initially, I am investing 6,806 in the company bond. On that bond, company will pay interest. That interest I'll reinvest elsewhere. So on that reinvestment also I'll get the income, the same 8%. That is what they are assuming. So this concept assumes that. So this calculation. So we have to understand this calculation. What is the assumption behind this calculation? So bondholder. So bondholder company. So bondholder has invested 6,806. Company will pay coupon. This is an investment. Or principal loan amount, coupon. And this coupon amount bondholder will invest elsewhere. This is coupon reinvestment. What is that, ma? Coupon reinvestment. On that reinvestment also you will get interest 8%. So here, whatever the amount invested he was, on that he was getting 8%. Whatever the coupon reinvested he was, on that also will get 8%. That is the assumption. On that, based on that assumption only, this calculation will correct. The calculation, whatever we have done, present value, future value formula, the inbuilt assumption is this point. So in the above calculation, the inbuilt assumption is that bondholder is investing 6,806 in the company. On that, company will pay 8% coupon. That coupon he will again reinvest somewhere. So on that reinvestment also he will get 8%. On that reinvestment also he will get 8%. That is what rate of interest prevailing in the market. Rates of interest prevailing in the market. It is not. I think system got struck. 1 minute. 1 minute. So on this 8% rate of interest prevailing in the market, it is not that company is only paying 8%. Not only company, everybody in the market is paying 8%. Not only the company in which have invested, everybody in the market is paying 8%. That is what is the assumption. Rate of interest prevailing in the market, yield 8% means what? Rate of interest prevailing in the market. So the company is paying 8% and everybody in the market also paying 8%. Therefore, outside also I'll get 8%. Okay, with this assumption we got it. With this assumption we got it. But here the point is that this 8% is promised by the company. This is fixed. Promised by the company. This is fixed. This is fixed. There is no uncertainty. No uncertainty. Company will definitely pay 8% for all the 5 years. Company will definitely pay 8% for all the 5 years. It is not changed. Company will definitely pay after 5. Company will definitely pay 8% for all the 5 years. It is not changed. Okay, this is not changed. But what is uncertain is this is uncertain. This is uncertain. So here this elsewhere investment, there is no promise. Today they are paying 8%. Tomorrow they will change. What is the situation? There is no guarantee that here with the company we have entered into an agreement, we have purchased the bond, company will offer say 8%. Okay, but that 8% if we reinvest somewhere else like a senior citizen savings deposits or bank fixed deposits, etc., on that also they are paying 8%. Fine. But what if the bank fixed deposit rates will change or the senior citizen deposits rates will change? That means this 8% offered in the market elsewhere is uncertain. That will fluctuate. That means what, ma? Coupon is certain, yield is uncertain. Coupon offered by the company is certain. That coupon amount again we are reinvesting. On that reinvestment will get the yield. That yield is uncertain. Yield will change. Coupon will not change. Did you got the lesson of the story? Okay. Did you got the moral from the story? Coupon is offered by the company to the bondholder. Yield is what the bondholder will get if he reinvest the coupon. Okay, that is what the important point I have to understand. Coupon is what a bondholder receives from the company. Coupon is what a bondholder. Coupon is what a bondholder receives from the company. Coupon is what a bondholder receives from the company. Okay, right. Look at this. Coupon and yield. Coupon. What a bondholder, what a company pays to the bondholder. What a company pays to the bondholder. What a company pays to the bondholder. Okay. What a bondholder obtains. What a bondholder obtains. If he reinvest the coupon received from the company. Coupon received from the company. If you reinvest the coupon received from the company, this is certain, this is uncertain and fluctuates. This is uncertain and fluctuates Okay, that is what the point. So here the concept is, look at this point. So while we are computing that 6,803, did you understand, ma? Did you understand these two? Just we have to make a note of that. What is the coupon and what is the yield? Coupon is what the company pays to the bondholders. Yield is what the bondholders obtains if you reinvest the coupon elsewhere. So coupon is certain and yield is uncertain and fluctuates. Okay, right? This is the story. This is the concept. Now if you look at this concept here, while calculating this 6,803, what we have is 6,803 of our investment plus interest is equal to 10,000. That is what we have calculated. This interest is two parts. What is the two parts interest? Coupons from the company, and next reinvestment on coupons, reinvestment income of coupons, reinvestment income. That interest is both. That income is comprising of coupon income received from the company and reinvestment income received from elsewhere. So this coupon and also reinvestment, both together that interest. Coupons received from the company and also reinvestment income, both together that interest amount. Okay. So out of this, this is certain. Okay. Coupon received from the company is certain. Right. So, but what we receive elsewhere? So what we receive from the company and what we receive elsewhere? What we receive from the company, or what we receive from the bond, and what we receive elsewhere. Both together is equal to that interest. What we receive from the bond and what we receive elsewhere, both together is the interest. Both together is interest. But what we receive from the company may be constant, but what we receive elsewhere may be changing. Then how you can protect yourself? This is the $1,000,000 question mark. Very practical issue, ma. Very practical issue. Okay. Today I have invested 6,803 with the assumption that whatever I received from the company, I'll invest elsewhere. On that elsewhere also I'll get 8%. What if I don't get 8%? What if I don't get 8%? Whether still I can realize the 10,000 my required value? The answer is yes. The answer is yes. Okay. Look at this. I'll explain. So first we'll do the calculation, then I'll explain the logic behind the calculations. Okay. Look at this. What they're asking is that what amount he will accumulate. He wants 5,000 after 5 years. He wants 5,000. He wants 5,000. What amount he will accumulate if the market interest rates continues to be 8%? If the market interest rates continues to be 8%, that means the yield is not changed. The prevailing yield is not changed. Therefore, no risk. Definitely he meet his requirements. So at the time of investment, he initially thought that he can reinvest at 8%. At the time of investment, he initially thought that he can reinvest at 8% and market interest rates are 8%. That means his expected market interest rates are continued for 5 years. That means he is not worried. Okay, I invested with the expectation of 8% yield. Okay, yield means reinvestment income. Yield means reinvestment income. I invested with the expectation of 8% yield. So market rates are also 8%. Therefore, my expectations has not gone wrong. My expectations are correct. My expectations are correct. So therefore, I don't need to worry. I don't need to worry. Now I have to prove that I can get 10,000. I can get 10,000. That I have to prove. That I have to prove. Look at this. How I'll prove it. Look at this. How I'll prove it. Okay. Right. So bond holder and the company. Look at this. Bond holder and the company. Bondholder company. So company is paying coupon. Company is paying coupon. How much is the coupon? 6,806 is the principal amount. 6,806 is the principal amount of money invested in the bond. So face value worth of bond purchased. This is face value worth of bonds purchased. Face value worth of bonds purchased. Face value worth of bonds purchased. 6,806 is the face value worth of bonds purchased. Okay, right. So on that interest, company is offering interest of 8%. On that company is offering interest of 8%. Bondholder. So bondholder has paid 6,806 today. Today the bondholder has paid 6,806 to the company. Bondholder has paid today 6,806 to the company. So first year company will pay coupon. First year ending, second year ending, company will pay coupon. How much is the coupon? 6,806 into 8%. 6,806 into 8%. 6,806 into 8%. 6,806 into 8%. Company will pay this 544.48. So 544.48. 544.48. Like that, company will pay for 5 years. 544.48. Like that, company will pay for 5 years. 544.48. Okay, 544.48. Like that, how many times company will pay? First, second, third, fourth, and fifth. First, second, third, fourth, and fifth. 544.48. Fifth, 5 years company will pay. 5 years company will pay. And whatever the receipt from the company, this first year investment elsewhere, market he will invest 5,544.28 he will invest, and the second also he will invest. All the coupons he will invest. All the coupons he will invest, but not the fifth one. Fifth one not necessary. Investing and immediately taking back is not necessary. 4 coupons he will reinvest. The coupon received at the end of the first year, the coupon received at the end of the second year, the coupon received at the end of the third year, coupon received at the end of the fourth year, he will reinvest. Fifth year coupon he will not reinvest because he wants, right? After 5 years, he has some commitment. Therefore, fifth year coupon will not be reinvested. Fifth year coupon will not be reinvested because fifth year ending, we want that amount for our obligation. Therefore, will not reinvest. Okay, right. So this 4 years coupon, he will reinvest. How much income he received on this elsewhere investment is the question mark. Now I'll write the table for that. Now I'll write the table for that. First year, second year, third year, fourth year, fifth year. First year opening. So this is a reinvestment account. Interest amount. Next, additional investment, reinvestment, current year investment. Okay, current year investment, new investment. Okay, new investment. Okay, additional investment, addition. Okay, this will take it as an addition, and closing. and closing and closing. Okay, and closing. Look at this. Interest is opening into 8%. Opening into 8%. Interest is, oh, this is elsewhere account, ma, reinvestment account. This is what? This is what I am writing, ma. What I am writing is a reinvestment account. Reinvestment account. Reinvestment account. Okay. Reinvestment account. Year. So year, reinvestment account. This is year. Okay, year 1, 2, 3, etc. Year 1, 2, 3, 4, 5, etc. Okay, look at this. Year 1, 2, 3. This is elsewhere, reinvestment, not from the company. Whatever I have received from the company, open year 1 opening, no, I have not reinvested. Therefore, interest will be 0. Year 1 interest will be 0 because I have not reinvested anything. Next addition, how much I have reinvested in the first year? 544.48. Every year, same amount. Every year I'll reinvest the same amount. Every year I'll reinvest, but not in the 5th year. Ending. This is 5th year ending. This investment is made at the ending of the year. Made at end of the year. Made at end of the year. Okay, ma. Made at year end. Made at year end. Made at year end. You understand? This is made at year end. 5th year ending, I don't repay. First year ending only I'll receive coupon from the company. First year ending only I'll reinvest. First year ending only I'll receive coupon from the company. First year ending only I'll reinvest. First year ending only I'll reinvest. Made at year ending. Closing. Closing what? Opening plus interest plus addition plus additional investment plus additions. Opening plus interest plus additions. So this is opening plus interest plus additions. You understand? This is the same thing. So first year ending I'm reinvesting. First year ending I'm receiving coupon from the company. First year ending only I'm reinvesting. First year ending I'm reinvesting for the company. First year ending only I'm reinvesting. So first year ending is nothing but second year opening. So second year I'll receive interest. Second year I'll receive interest. Second year I'll receive interest. Okay, so this will be the closing. This will be 0. 5th year ending, I don't reinvest anything. 5th year ending, I don't reinvest anything. 5th year ending, I don't reinvest anything. This is the reinvestment amount. Okay, this is the reinvestment income. Okay, so this is the reinvestment income. So interest or reinvestment income. Okay, reinvestment income. So this out of this 2,649, 471 is interest, ma. Reinvestment income. Reinvestment income. This is only the income. This is only the income. Sir, that 4,000. This is our reinvestment. Look at this. How much we got this? So this 2,671. Look at this. This will be the same. 2,649. Out of 2,649, whatever we have received, out of the 2,177 is we received whatever we have invested. Reback of principal investment, not income. Our income on reinvestment is only 471. Reinvestment income is 471. This is what we have received from the company and reinvested elsewhere and got back. This is our recovery of investment, not income. We have reinvested and we have received again. Our recovery of investment on that interest. So total we have received this point. So in the reinvestment, say bank fixed deposit. In the bank fixed deposit, we have invested 2,177. From where we got 2,177? From the company. Whatever 2,177 we have received from the company, that we have reinvested in the bank fixed deposit. On that, bank has given 4,700 interest. So our amount we have deposited and interest on that. Total amount received is 2,649. Amount invested, okay, reinvestment amount. Reinvestment amount. This is reinvestment amount. What is this? Reinvestment amount. Reinvestment amount. This is the reinvestment income. This is the reinvestment income. Total recovery. So this is the water point when the yield is 8%. When the yield is 8%, right? Now that means at the end of the 5th year, look at this. At the end of the 5th year, from elsewhere, bondholder will receive how much? Bondholder receive 2,649.77. At the end of the 5 years, after 5 years, bondholder will receive from the company 2,649.77. After 5 years, bondholder will receive from the company 2,649.77. That is what he will receive after 5 years. Okay, right. Now, one more receipt is there. After 5 years, what he has to do? He has to sell the bond in the market. He has to sell the bond in the market, not to the company. He has to sell the bond in the market. Why? Because look at this concept. Company's bond is 6 years maturity. You want to sell the bond after 5 years. Company will redeem the bond after 6 years, not after 5 years. But you want to sell the bond after 5 years. Therefore, we have to sell in the secondary market. We cannot redeem the bond with the company. Company redeems the bond only after 6 years. But we want the money after 5 years. We want the money after 5 years. So therefore, we are selling the bond in the secondary market. We are selling the bond in the secondary market. Whatever the bond we have received from the company today, whatever the bond we have received from the company, that we are going to the secondary market, stock exchange. Stock exchange, we are selling the bond and receiving the amount. This is the sale price of the bond. 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 How much is the sale price? How much is the sale price? That means we need to calculate P5. We need to calculate P5. Price at which we can sell the bond after 5 years. Price at which we can sell the bond after 5 years. Okay. So price at which we can sell the bond after 5 years. That is what we have to calculate. Okay. So price at which we will sell the bond for after 5 years. That is what we have to calculate. Okay. So price at any point of time is what? Discount value of future cash flows. Discounted of future cash flows. P5. So after P5, company redeems only 6th year. Only 1 year interest is left over. The bond life is only 6 years. The bond life is only 6 years. We are selling the bond 5 years. After 5 years, that means leftover is only 1. P5 means 5 years is completed. 5 years is completed. Bond redemption, N is the 6th year. Bond redemption, N is the 6th year. That means only 1 year left over. Only 1 year left over. Only 1 year left over. So therefore, P5 is equal to what? P5 is equal to what? Interest at the rate 6% plus 1 plus 5 whole to the power of 1. 6th year interest. Not 6 years interest. 6th year interest. 6th year interest plus redemption price divided by 1 plus 5 whole to the power of 1. 1 plus 5 whole to the power of 1. So interest for 6 years, every year interest is same 544.48 divided by yield is same. We said 1.08 plus redemption price is 1000. Redemption price is 1000 divided by 1.08. Divided by 1.08. So how much will get? 1544 point. Okay. So 1544. Both we are receiving 10,000. How much it is? 10,000 bond, right? So 10,000 bond, not 1,000. It is 10,000. Okay, 10,000. So okay, 10,000 plus 544.88. So 10,544 divided by 1.08. 1.08. 1.08. So the total amount will be 9,763. 9,763. 9,763. This is the amount we got, 9,763. Okay, after 5 years, bondholder is selling the bond in the market and he was receiving 9,763. 9,763.41. 9,763.41. And from reinvestment, he was receiving 2,649. Check up it whether this total will become 10,000 or not, because he has to meet his goal of 10,000. He has to meet his goal of 10,000. Check out this. 9,763.41 plus 2,649.77 plus 2,649.77 plus 2,649.77. This will be, sorry. No, this interest income, sorry. So on top of that, we have to receive this reinvestment income. This is just recovery of interest. This is just our recovery of investment. This is just our recovery of investment. Sorry. 10,000 is the face value of the bond, but we have not invested 10,000. We have invested only 6,806 worth. Sorry, I have confused. So even though bond is each bond 10,000 is the bond, but we have not invested 10,000. We have invested 6,806 only. Investment is 6,806 only. We have calculated interest on 6,806 only. We have calculated interest, this 544, we have calculated on 6,806 only. That means our redemption price is only 6,806. Our redemption price is only 6,806. Sorry. Our redemption price is only 6,806. Therefore, we'll get same 6,806. So 7,350. So 7,350. Okay, this bond price is 7,350. 7,350.48. 7,350.48. 7,350.48. 7,350.48 divided by 1.08. 7,350.48 divided by 1.08. It will be same 6,806. It will be same 6,806. Okay. It will be same 6,806. So 6,806 plus this point. Okay. Look at this. Exactly we got 10,025. Exactly we got 10,025. Okay. Exactly we got 10,025. Do you understand, ma? 10,025 we got it exactly. Sir, how we got 10,025, sir? Look at this. What are the three amounts? Sale price of the bond. This 6,806 is the sale price of the bond. This 6,806 is the sale price of the bond. This 6,806 is the sale price of the bond. 6,806 is the sale price of the bond. Next, this 544 is the fifth year coupon, because fifth year coupon I have not reinvested. Fifth year coupon I have not reinvested. Fifth year coupon I have not reinvested. This is fifth year coupon. This is fifth year coupon, and this is the reinvestment proceeds. Reinvestment proceeds. Okay, so bondholder, company, secondary market, stock exchange, reinvestment. So look at this three amounts how we got it. Three amounts how we got it. Okay, so this is what three amounts we got it. So I'll explain. Look at this point. Okay, when after 5 years, what happens? Bondholder, company, reinvestment elsewhere, and stock exchange, secondary market, secondary market. So fifth year he was receiving 544.48. Fifth year coupon that he has not reinvested. Fifth year ending coupon. Next, bondholders is selling the bond in the market. And he was receiving how much? And he was receiving 6,806. Sale price of the bond in the secondary market. Sale price of the bond in the secondary market. Sale price of the bond in the secondary market. Sale price of the bond in the secondary market. Okay, so sale price of the bond in the secondary market. Now, next, so bondholder is receiving from reinvestment. How much he was receiving from reinvestment? 2,649.77. This is a very detailed explanation. This is a very detailed explanation how the bondholder can meet his expectations after 10 years. This is how the bondholder can meet his expectations. Now sum up all the three, whether you will get 10,000 or not. That is what we have received. 6,806. 6,806, 5,544, 544.48, 2,647. Just take a screenshot of this. How he was able to meet 10,000. How he was able to meet 10,000. How he was able to meet 10,000. That is how we have to plan for our client. So if our client comes and says, sir, I want 10,000 after 5 years. So this is how we have to invest. This is how we have to explain to the client. After 5 years, receive the fifth coupon from the company, sell the bond, the secondary market, receive 6,806, receive 2,649 from the reinvestment income. All the put together meets your goal. So that is the complicated task of the fund manager. He has to invest in multiple places. End of the day, he has to put 10,000 in the hands of the bondholder. End of the day, he has to put 10,000 in the hands of the bondholder. So this is how the bondholder will get 10,000. Okay, right? This is what the point. So first, this is the end of the picture. This is the end picture. How the investor got 10,000. How the investor got 10,000. This is the end picture. Out of that, 544.8 is the fifth year coupon that is not reinvested. Fifth year coupon that is not reinvested. Next, 6,806 is the sale price of the bond. 6,806 is the sale price of the bond, and reinvestment proceeds are 2,649.77. And reinvestment proceeds are 2,649.77. This is when the yield is 8%. Okay, ma, when the yield is 8%. When the yield is 8%. When the yield is 8%, this point. So out of the, when the yield is changing, when the yield changes, these two will change. 2,649 and 6,806, they will change. The sale price of the bond will change and reinvestment income will change when the yield changes. When the yield changes, okay? So when the yield changes, the reinvestment income and the coupon amount will change. The reinvestment income and the coupon amount will change. Okay. Now I'll show you. Calculations. So when the yield is 6%, bondholder, company, so he will receive same. This will not change. 544.48. From the stock exchange, he will sell the bond and he will receive how much? P5 is different. There we have to put 6. Look at this. P5 is equal to 6,806. 6,806 plus 544.48. How much it is? 7,350.48. 7,350.48. 7,350.48 divided by 1.06 I have to take, because yield is 6%. So therefore, if I take 7,350.48 divided by 1.06, this will be 6,934.42. This will change. 6,934.42, 6,934.42. Okay, 6,934.42. Next, this is a reinvestment income. So reinvestment income. From reinvestment, how much you'll get? From reinvestment, how much will get? From reinvestment, how much he will get? From reinvestment, how much will get? Look at this. From reinvestment, the same table, reinvestment if yield is 8%, reinvestment account if yield is 8%, reinvestment account if yield is 8%, reinvestment account if yield is 8%. Now I have to take out this point. Reinvestment income if yield is 6%, reinvestment income if yield is 6%. Okay, the same thing, opening into 6%, opening into 6%. Okay, opening into 6%, reinvestment income, reinvestment income, this will be 6%. This will be 346.88, 346.88, 346.88. Now total of these three, whether these three will become 10,000, 6,934. So 6,934. Look at this here. 6,000, first 544.48, that will not change, 50 year coupon. Next 6,934.42 is the sale price in secondary market. Next 2,524.80 is the reinvestment proceeds. This is how the cash flow at maturity. 10,000, round figure, rounding off figure, 3 rupees extra. Exactly, you are meeting 10%. That means when the yield is 8% also you are able to meet. When the yield is 6% also you are able to meet. This is how the transaction is perfectly designed. You understand? That's why I said it's very realistic example. It is very interesting and very skillful exercise. The fund manager has planned in such a manner that irrespective of the yield, investor is able to get 10,000. Fund manager is performing his promise, is delivering his promise, irrespective of whatever is the yield prevailing in the market. The investor is still getting 10,000. The investor is still getting 10,000. Okay, this year same 544.48, 544.48. This is 6,806. This is 6,806. This is how much? 2,649.77. 10,000. Do you understand this? Okay, irrespective of the scenario. So what should I write, ma? What should I write this? What I should write here? What I should write here? So can I write here 5th year coupon, 5th year coupon, last 5th year coupon or last year coupon, 5th year coupon. Okay, sale price in the secondary market, sale price in the secondary market. Why? Because I'm not selling to the company. I'm not redeeming in the company, because company will redeem only after 6 years, but I want money after 5 years. Therefore, I cannot go to the company. If I can wait for till the end of the 6th year, yes, I can go to the company and can collect from the company. But the company pays only after 6 years, but I want money after the 5th year only. Therefore, I have to sell in the secondary market. Therefore, reinvestment proceeds. Reinvestment proceeds. The reinvestment proceeds is the 10,000. So yield is 8%. Yield is 8%. So this is yield is 8% and this is yield is 6%. Yield is 6%. Okay. Yield is 6%. Yield is 6%. Okay, yield is 6%. Okay, yield is 6%. Right now, yield is 10%. They said yield is 10%. How will we get it? Yield is 10%. Yield is 10%. Okay, yield is 10%. This last year coupon will not change. Last year coupon will not change. 5th year coupon, what we receive from the company will not change. Okay, sale price in the secondary market. Sale price in the secondary market. Look at this. If the yield is 10%, 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 okay. So if the yield is 10%, so bondholder, company and reinvestment, bondholder, company and reinvestment, okay. So from the bond company, he will receive 5th year coupon 544.48, 5th year coupon he will receive same 544.48, that will not change. From the secondary market, from the stock exchange, secondary market, how much you'll receive? Look at this. P0 is equal to 7,350.48 divided by 1.10. I have to take, because the yield is 10%. Because the yield is 10%. So 7,000 same. So 7,000. This is 7,350.48. 7,350.48 divided by 1.08. Okay, this will be 7,004 divided by 1.06. Okay, this will be 1.10. This is the sale price 6,682.25. So 6,682.25. 6,682.25. Now reinvestment. Reinvestment, we have to change the table. We have to change the reinvestment table. Reinvestment account of 10%. Reinvestment if the yield is 10%. Reinvestment if the yield is 10%. Okay. So reinvestment if the yield is 10%. Reinvestment if the yield is 10%. So same I have to take opening into 10%. Opening into 10% we have to take. Opening into 10%. Opening into 10%. Okay, right. Opening into 10%. How much we got? 2,779.62. 2,779.62. Now check out it whether all the three together becomes 10,000 or not. All the three becomes 10,000 or not. Check it out. So this is our cash flow, right? Cash flow at maturity. This is cash flow at maturity. Cash flow at maturity. How much we have received, ma? How much we have received coupon? Reinvestment 2,779.62. Okay. That is the divinity. That is how the fund manager has structured the transaction. Irrespective of what happened in the market, investor receives 10,000. That is a very skillful exercise. That is a very skillful exercise. Irrespective of what happened in the market, the investor will get same 10,000, except the rounding of figure. 2 rupees, 3 rupees are rounding of figures. Okay, 10,000 investor is able to get, irrespective of what happened in the market. Most of the students will just by heart the problem, but they don't understand this logic. This is what is called as immunization. So most of the students, they know the word called as immunization, but how the immunization works, they don't know. This is crystal clear clarity of how the immunization works. Immunization is protection. Irrespective of what happened, you are protected. Okay, irrespective of what happened in the market, you are protected. You will get same 10,000. You will get same 10,000. Okay, so one by one table write out. This table is called what? Cash flows at maturity. This table is called what? Cash flows at maturity. Cash flows at the end of 5th year. Cash flows at the end of 5th year. Cash flows at the end of 5th year. Look at this. Irrespective of what happened in the market, are you not able to source of receipt, source of cash flow? Source of cash flow, irrespective of what happened in the yield, still you are able to provide your client with this concept. Okay, right. This is the total cash inflow, Okay, irrespective of what happened in the market, I'm able to get irrespective of what happened in the market, irrespective of what happened in the market, my investor is able to get 10,000. Just take a photo of this one. This you need not present in the exam. For you to explain the concept called as immunization, I have shown. Okay, to demonstrate or to prove that immunization will work. Immunization means irrespective of what happened in the market, you will end up with the same amount. Sir, what is the how it has performed? How it has what we call it? So how this transaction is happening? What is the logic behind that? Just simple. Okay, this is 1 point. Cash flows at the end of the 5th year. Now I'll do one more calculations. I'll give one more calculations. Okay. So one more calculations is source of income, not the cash flows. I'll take source of income. Income is actual book concept. Cash flows is cash flow based. Source of income. Coupon payments from the company. So what is the coupon payments from the company? Same 544.48, 5 years. 544.48 into 5 years. 544 total, 544.8 into 5 years. Okay, 2,700. Total coupon payments in the company. I'll write it here elsewhere, otherwise it will be very clear for you. So coupon payments on the company for 5 years, for total 5 years, Coupon payments of the company, total 5 years. This will not change. Okay. Next, look at this point. Income on reinvestment. How much income we got reinvestment? This point, 4,471.85. Income on reinvestment. Okay, this is the income on reinvestment. Next, this is the point. The income on reinvestment. Okay, right. Income on reinvestment. This is the income on reinvestment. Next, this the yield is 10%. When the yield is 10%, income on reinvestment, next, capital gain or loss on sale of bond, capital gain or loss on sale of bond, capital gain or loss on sale of bond. Okay, look at this, capital gain or loss on sale of bond. So this means sale price, purchase price minus sale price minus purchase price, sale price minus purchase price, sale price minus purchase. Sale price is different here. What is the sale price? Here the sale price is 6,806. Purchase price is also 6,806. That will be zero. Capital gain is zero. Here the sale price is 6,934. Purchase price is same 6,806. Purchase price is not changed. Capital gain we bought. Here sale price is how much? Here sale price is 6,806. 6,806. Capital loss. Capital loss. Okay. Now look at this. This is another way of presentation. This is another way of presentation. So recovery of amount invested. Okay, recovery of amount invested. Okay, right. Recovery of principal amount invested. Recovery of principal amount invested. Recovery of principal amount invested. Principal amount invested is 6,806 only. Recovery of principal amount invested is 6,806 only. Now, if you take out this point, this is another way of presentation. Same 10,000. How we got this is another way of presentation. I am giving multiple presentations so that you can understand the concept in detail, because this is what is really required. Investment banks in the mutual fund, they don't pay you lakhs of salary just like that unless until you know this concept in detail, not just by adding the formula or mugging up or substituting the formulas. They don't pay lakhs of salaries just like that. You need to understand this concept in detail. Look at this. This is how you concept it. So here the concept is that initially my planned reinvestment income is 4,785. Originally I planned reinvestment income of 4,785. When the yield is falling, reinvestment income is decreased. How much is decreased? Same. The difference between these fallings. Look at this point. When they look at this concept, difference. So when the yield falls to 6%, okay, when the yield falls, my reinvestment income decreases by 124%. The decrease in reinvestment income is compensated by capital gain. So the decrease in reinvestment income is compensated by capital gain. This is how we have to structure the transaction. Here, when the yields are rising, my price is decreased. When the yields are rising, my price is decreased. But that means I have got a capital gain, but I got reinvestment income. Same. Look at this concept. That means when the yield is falling, reinvestment income decreases, but the decrease in reinvestment income will be compensated in the form of capital gains. When the yield is rising, I'll get the capital loss. That capital loss is compensated in the form of higher reinvestment income. That is the concept. Okay, I'll write it here now. Look at this. Okay. When the yield falls, reinvestment income decreases. But the capital gain will compensate the fall in the yield, reinvestment income. But the capital gain will compensate the fall in the reinvestment income. Next, when the yield rises, okay, when the yield rises, capital loss will be incurred. But such capital loss will be compensated by increase in reinvestment income. This is what is immunization. If I'm getting lost somewhere, definitely I have some other remedy to recoup or compensate that. That is what is immunization. Most of the students, they don't know how the reinvestment works. Okay, simply they will calculate the yield, etc. But this is how the reinvestment works. Okay, so when the yield is falling from 8% to 6%, my reinvestment income is falling, which is compensated by the capital gain. When the yield is rising, I'll get capital loss on the bond. That capital loss is compensated by increase in the reinvestment income. Look at this. From here to here, increase in reinvestment income. This capital loss will be compensated by here. From here to here, reinvestment income decreases. The decrease in the reinvestment income is compensated by this capital gain. The decrease in reinvestment income is compensated by this capital gain. This is how the immunization strategy works. This is how the immunization strategy works. Okay, right. This is the concept. This is how the immunization strategy works. Okay, I am giving multiple presentations for you. You can get total receipts. Okay, total receipts description. You can take the screenshot of this, or you can take a note of it. You can pause the screen. You can pause the screen and copy the answer. You can pause the screen and copy the answer, or if you are watching the video through laptop, you can take the photo through mobile. You can take the photo through mobile. How the immunization works. How the immunization works. Okay. You can take this one shot. This one screen you have to take it. Description, yield. This one thing we have to take it. Next, cash flows at the end of the 5th year. Cash flows at the end of the 5th year. Take this also. Pause the screen and copy it. Pause the screen and copy it, or take a photo of it. Cash flows at the end of the 5th year. Cash flows at the end of the 5th year. Different presentation. Total cash flow I got. Okay, total cash flow I got. Different way of presentation. Same point, same concept, different way of presentation. Okay, right. You can pause the screen and copy this screen also. You can pause the screen and copy this answer also, or take a photo out of it. Okay. Next, you can pause the screen and copy this answer. You can pause the screen and copy this answer. Next, you can pause the screen and copy this reinvestment income. You can pause the screen and copy this reinvestment income. Okay, you can pause the screen and copy this reinvestment income. You can pause the screen and copy this reinvestment income. You can just take a screenshot of this one. I'll give it to you. You can take a screenshot of this. Just I'll put for your understanding. Okay, this is the. You can take a photo and or let me give some tabular format so that it will be at least it will be good for looking. Okay. So reinvestment account, if the yield is 8%, reinvestment account if the yield is 8%, reinvestment account if the yield is 6%, reinvestment account if the yield is 10%, reinvestment account if the yield is 10%. So how will perform from the company, how will receive from the company, and how we reinvest elsewhere, how we reinvest elsewhere. Okay, this is the reinvestment account, and this is the cash flow at the end of the 5th year. So you can pause the screen and copy it. If you are watching the mobile, you can pause the screen and copy it. If you are watching in the laptop, take a photo in the mobile, the screen. Okay, right. This is what the point. I hope you understood this presentation. Now I need to put one more presentation for you, how I got the sale price. Sale price in the secondary market. Sale price in the secondary market. I'll write that also. Yield is 8%. Okay, yield is 8% and this thing is 6%. Okay, right. Sale price in the secondary market. Only 1 year left over. Only 1 year left over, ma. Only 1 year left over. I'll write the yield also for your sake. Only 1 year left over. Okay, only 1 year left over. 1 year, 1 year. 5 years is completed. 1 year, 1 year, 6th year, not 6 years. 6th year. Only 1 year is left over. Only 1 year is left over. Cash flow. This is our routine calculation of yield. Cash flow, how much? 544.48 coupon payment and 6,806 principal repayment after 1 year. Next, discount factor. Discount factor at the rate how much if the yield is 8%. Discount factor if the yield is 8%. 1.08 to the power of 1. This is our routine using the formula. Okay, cash flow and discounting factor. With this formula, you know, Nama, this presentation you are familiar, right? How I am calculating the price total. This is the price. Okay, this is the price of the bond. This is the price of the bond. Price of the bond. Okay, so this is the price of the bond. Price of the bond. Okay, price of the bond. Sale price of the bond. Sale price of the bond. Sale price of the bond. This is the sale price of the bond. If the yield is sale price of the bond, if the yield is how much? Sale price of the bond, if the yield is 8%. Sale price of the bond, if the yield is 8%. Okay, right. Sale price of the bond, if the yield is 8%. This is the sale price. If the yield is 8%. Okay, sale price of the bond if the yield is 8%. If the yield is 8%. If the yield is 8%. So I'll put it bold. sale price of the bond if the yield is 8%. Okay, same if the yield is 6% sale price. So you can take a note of this also. Yield is 8%, yield is 6%. How will you get yield is 6%? The discount factor will be 6%. This will be 1.06. 6%. You will get 6,934.42. Now, if you sale price, if the yield is 10%, if the yield is 10%, so sale price if the yield is 10%, sale price if the yield is 10%. Okay, sale price if the yield is 10%. This will be 1.10. 1.10. This will be 1.10. 6,688. Do you understand whatever we got in this table? Whatever the sale price 6,806, 6,934, 6,682. Just I am giving the calculations for that. How I got it? 6,806, 6,934, 6,682. Okay. That is what the point. This how you can pause the screen or you can take a photo out of this also. You can take a photo of this also. Sale price of the bond if the yield is 8%, right? So this is what is the magic. Now I have to explain what is the logic for this magic. What is the logic for this magic? Okay, look at this. The logic for this magic is that the logic for this magic is very simple. Okay, the logic for this magic is very simple. I'll show you that. I'll show you the logic for this magic. Okay. This is the duration calculation. I have shown in the previous problems how to calculate the duration. I have explained the previous problems how to calculate the duration. How to calculate the duration. I explained the previous problem how to calculate the duration. So first year cash flow is what? 544.48. All the years 544.48 is the cash flows. All the years 544.48 is the cash flows. Next, the bond is 6 years, right? The bond is 6 years. Therefore, we have to take 6th year also. 6th year also. 6th year also. This I am computing the duration of the bond. I am computing the duration of the bond. I am computing the duration of the bond. Discount factor at the rate 8%. Present yield. Discount factor at the rate 8%. Discount factor at the rate 8%, 1.08. I'm just calculating the duration of the bond mark. So that's why I'm using the same format, you know, out of it, how to calculate the duration. You know how to calculate the duration. Okay, you know how to calculate the duration. This is the price present value into year, present value into year, present value into year, present value into year, present value into year. Okay, right. Present value into year. These are the present value into year. Present value into year. Okay, present value into year. This is the formula we know. Present value into year. The total we will get 25,773 will get this total 31,279. That is the duration. How you got the duration? How you got the duration? 31,000 divided by 642. That is what the sum of the products. The sum of the product. This is what the duration is 4.94 years. That is rounded off to 5 years. Rounded off to 5 years. 4.94 is 5 years. So this immunization is happening. This immunization is happening. Okay, because the duration of the bond is 5 years and the investors required investors holding period is also 5 years. That is why this immunization is happening. That is what when the immunization will work out. So this is called as immunization. This is called as immunization. This is called as immunization. Okay, so this is called as immunization. 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 So this will work out. This will work. This will happen. Immunization occurs. Immunization occurs. Immunization occurs. Immunization occurs when the immunization occurs, right? When the duration of the bond, when a person purchases the bond, when the investors holding period, when the duration of the bond, when the duration of the bond and the investors holding period matches, and the investors holding period matches, and the investors holding period matches. In the given case, the investors holding period, the investors holding period or horizon, investment horizon, investors holding period is 5 years. The investors holding period or investment horizon is 5 years. The investors holding period or the investors horizon is 5 years, and the duration of the bond is also 5 years. And the duration of the bond is also 5 years. And the duration of the bond is also 5 years. Is also 5 years. So 4.94 rounded off. 4.94 rounded off. 4.94 rounded off. Okay. This is what is this happening. Therefore, what is meant by immunization? When the immunization works when the duration of the bond is equal to the investor's holding period. Investor is holding for 5 years, duration of the bond is also 5 years. That's why immunization works. What is the benefit of immunization? The decrease in the reinvestment income will be compensated by capital gain, and the capital losses will be compensated by increase in the reinvestment income. This is what the immunization strategy will work out. Okay, when the immunization happens, this is what is the situation when the immunization happens. Okay, I hope you understand this concept. You can watch the video a couple of times once again to get the clarity. So I have given multiple things. What I'll do is that whatever the calculations I have done, so anyway your main answer will be there in the main book solution, whatever I've given. Whatever the rough calculations I have done, you can take the photo out of it. Okay, you can take the photo out of it, all these rough calculations. Okay.